Bitcoin, Ethereum, I'm not going to have that the philosophical argument whether it's a good investment, bad investment. I get why putting it inside of an ETF wrapper like gold, but now you've got every coin that comes to market. Like Hyperliquid is not legal in this country, yet it is in an ETF wrapper.
All right, joining me will be Mike Akins, founding partner of ETF Action, which is an independent ETF data and research platform. And I'll tell you, if there is an ETF metric or data point that exists out there, they probably have it on the platform, along with all sorts of other in-depth ETF analysis and commentary. And Mike, of course, is a longtime industry veteran. He was previously head of ETFs at ALPS, where he helped build and grow that into a multi-billion-dollar ETF business. And he's someone I just enjoy talking shop with. And that's exactly what we'll do this week. We are going to bounce around on several different topics, including some pretty big news last week with Goldman Sachs announcing that they would be acquiring NEOS Investments, who's a $30+ billion ETF issuer. And of course, that follows Goldman closing on the acquisition of Innovator ETFs earlier this year, another $30 billion issuer. And so Mike and I will have our reaction to that. Let's see. We'll also talk about some new filings for NHL futures contract ETFs. You heard me right. There was a filing late last week for ETFs that would allow you to bet on the performance of NHL teams. We'll see if they get approved, but regardless, there's clearly this continued blurring of the line between investing and gambling when it comes to ETFs. So we'll get into that. We'll also touch on crypto ETFs. And then I want to find out what Mike is watching in the industry moving forward. This should be a fantastic conversation. Now, later, I'll be joined by Paul Baiocchi, head of fund sales and strategy at SS&C ALPS Advisors. So very nice synergy this week with ALPS on the podcast. But they, of course, are nearly $23 billion ETF issuer. And we're going to look at two of their ETFs in particular that are seeing some strong performance and investor interest. The ALPS International Sector Dividend Dogs ETF, ticker IDOG, and the ALPS Smith Core Plus Bond ETF, ticker SMTH. And as part of that, we'll also discuss international stocks and the fixed income market more broadly. So that should be an excellent conversation as well. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So first up is ETF Action's Mike Akins, who is joining me from Denver. Mike, it is so great having you back on here. I feel like it's been a while.
It has. It's been a little time. You and I touch base plenty, but thanks for having me back on, Nate. It's great to see you on the show.
Well, I'm excited to have you here. And as I mentioned, we are just going to jump around on a number of different topics. And let's just start with this big story from last week, which is that Goldman Sachs will be acquiring NEOS Investments in a deal valued at up to $2.25 billion. $2.25 billion, which is remarkable when you consider that NEOS just launched their first ETF 4 years ago. And now here they are with over $30 billion in assets. And they have Goldman Sachs knocking at the door with a $2+ billion check. What was your initial reaction to this?
Well, first off, congrats to the NEOS team. It's a credible group of people over there with some really impressive backgrounds. So I'm not surprised by their success. The speed at which it happened is incredible. I mean, to go, from zero in assets to 40 billion like they did, just to turn it around so quickly was really impressive. But my initial thought is, two things. One is you kind of have this Goldman, JP Morgan. There's always been intense competition between those two. So I'm not surprised to see Goldman go pick up the second largest synthetic income or derivative income shop in the space, considering, that JP Morgan kind of led with JEPI and JEPQ, but also I think more broadly, as ETFs continue to grow and as shops lean into them as their primary allocator of capital, you take a big bank, a big wirehouse, or even firms like Ray J who are getting into the ETF space. If you're going to have a house team building models, why not build them with your own tools? And I think we're going to start seeing a lot of the bigger shops continue to find out, how do I build out my lineup that fits along? Core beta, it's tough to play in 2 basis points, 3 basis points. But when you get into these satellite pockets that have grown, have proven, a place in a portfolio, it's hard to, as a bank, allocate to a competitor's product when, in some cases, ETFs can be considered a commodity. They're just a vehicle to allocate assets to a particular strategy.
By the way, I try not to take too many victory laps on this podcast, but I called this, right?
I do.
Yeah,
Yes.
so one of my 2026 ETF predictions is that we would see an uptick in ETF mergers and acquisitions, and I named NEOS as a potential acquisition target. I was just doing some like back of the envelope math, which hopefully this is right. But if you look at the NEOS lineup, the average expense ratio for their ETFs is something like 70, 75 basis points. And last I checked, I think I've thrown out 30 billion. You mentioned 40 billion, but they were somewhere around, let's say, 33 billion in assets. And so if you do the math on that, that works out to about 230 million in revenue. And so if Goldman's paying, 2.25 billion, that's 10 times that in terms of the deal. And one question I have for you is two things here. First, do you think that Goldman's strategy here, you mentioned competing with JP Morgan, but if you look at the two acquisitions, you have Innovator and you have NEOS, and both offer what we call in the industry boomer candy, right? With defined outcome ETFs and then option income ETFs. Is it that simple that Goldman wants to have a bigger footprint in that space, and then of course they can leverage the existing distribution they have? Like if you just step back and look, okay, why are they paying 10 times revenue for this? Is it that simple?
Yeah, I think it really is. The ETF industry is so split between the core beta, which drives the majority of assets, still does, even with all the flows going into active, all the flows going into synthetic income buffers. Core beta still is the primary driver of allocations, and that is almost a free bucket. I mean, honestly, the banks that like State Street or whoever who can make money on sec lending and things like that make a lot of sense. But being able to round out your lineup with products that actually still have a competitive fee set, I think it's that simple. I don't think I would look beyond it any further than that.
What is the risk of this deal for Goldman? And before you answer that, let me mention that when Goldman acquired Innovator, I said they paid a pretty steep price for ETFs in a category where we know fee competition is increasing, because that was a $2 billion deal as well. And as you know, a lot of Innovator's ETFs are pretty expensive, right? Those are around 80 basis points on average. And we now have other issuers coming into that category at around 25 basis points. And to be clear, Mike, I'm not saying that deal won't be successful. It looks like they've already fairly smoothly, begun integrating Innovator, but I do think there's at least some risk there if other issuers are able to gain traction at a lower price point. And so do you think there's a similar risk with NEOS? Again, their ETFs aren't the cheapest. And I would say the options income ETF category might be even more competitive than the defined outcome category. So is that the biggest risk here?
So I do think yes, the risk fee compression is always going to be a risk in the ETF industry, and they can compete with that. They have the asset. If you take the Innovator side, they can start scaling down their fees if they need to. Obviously, that would hurt the margins on the deal and the ultimate return on the investment. But they can certainly combat that internally, I'm sure, as they bring it in-house. They get some synergies. They can find ways to create efficiencies there and counteract competitors coming in at a lower price who have no liquidity, who have no assets, who have no experience in the space. And that's something we'll talk about maybe a little bit later, just talking about the basics of ETFs, because it seems like everybody wants to launch one, but it's not that easy. On the synthetic income side, I do think there's differences in the products, right? If you look at what NEOS did, they built, these are ex-Milliman guys that understand writing options. They're actively managed. Yes, they're indexes in terms of their underlying holdings. They're just tracking the Qs, tracking SPY, tracking EFA. But that writing of that contract is a big deal, and there's no guarantee that they're always going to be able to do this. But in their first 4 years of existence on their big bulge products like QQQI and SPY, they have done an incredible job of managing their upside and downside capture to their broad index, and they've also done it in a way where they're returning the income as ROC. So I almost think you got, you mentioned you have Paul coming on later, but you think about MLPs, right? The ALPS has a huge MLP product. They pay a huge dividend, but most of that dividend, because of MLP structure, is return of capital. So you're deferring that tax payment because you're just lowering your cost basis till someday. That's also a huge moat on the product itself. So if I hold SPY or QQQI for a long time as part of my allocation, my models, my cost basis keeps getting smaller and smaller, which makes it difficult to sell it because you're going to have a bigger tax obligation at that point. And then, of course, I don't want to get into it, but you can go down. If it's a life asset, you can pass it off and get stepped up cost basis. So there's a moat there. On the risk side, though, I will say one thing other than they'll get through this, but it might be painful. The proxy, right? NEOS did an incredible job building up a retail base. If you go and look at their 13F filings, it's starting to see a lot more advisors come in. And the 13F filings for NEOS-based products has been exploding to the upside. So you're seeing more advisors and RIAs using their products. But at first, and a big portion of their assets are still retail, that's going to be a painful process to go out and get all those proxy votes to do the change of control, which is required in our industry.
It's a great point on the proxies. I remember several months back with QQQ converting to an open-ended fund, and Invesco was war dialing everybody, trying to round up the proxy votes. And obviously that's one of the biggest ETFs out there, but not necessarily the easiest thing to do. And to your point, especially if you have a more retail-esque base of holders. But just to kind of put a period on this, it sounds like you like this deal for Goldman overall.
I think it's a great deal. I mean, I think this is I'm not an investment banker, so return on investment and all of that stuff, but I think it fits how they're building their models, how they're allocating for their clients, their ultra high net worth client base, and I think it just kind of fits into their general practice. And then the acquisition of NEOS, in my opinion, it's a leader in that space. They have a competitive moat, unlike a lot of other products, because of that. That cap, the way they return of capital creates that embedded cap gains, which makes it more difficult to say, oh, I'm going to switch from QQQI to JEPQ, or I'm going to switch to some other product, because you will face that capital gains issue.
I think I like this deal overall. We'll see if the price paid what was a little steep, but I always come back in the ETF space. This, it's distribution. Distribution is king. Goldman has that in spades. And there's not a ton of issuers out there that have the type of distribution that Goldman does. And so if you have an opportunity to acquire differentiated issuers, or issuers that have some sort of moat, whether that was because they were first mover, they have branding, whatever the case may be, I like that. I like somebody with distribution being aggressive and trying to build out their lineup, because I could make the argument, and I probably have on here over the past 10 years or so, that Goldman hasn't been aggressive enough in the ETF space because of the distribution that they have. And so from that standpoint, I think this makes sense. Let me ask you this before we move on. Are there any other ETF issuers that you think look like prime acquisition targets, or are there larger issuers like Goldman who you think should be looking to make an acquisition?
On the acquisition side, it's tricky. I think for the big issuers looking to make an acquisition, I think it's a tricky game. It's got to be the right setup. So Innovator, and Goldman getting kind of the two key options. I think those were really big bulge brackets, but the other big players in those spaces in synthetic income and buffers are already big players, right? Whether it's PGIM or Allianz or whoever it is, that these folks are not going to go, they're not going to be bought. So there's not like a opportunity there to go get those differentiated full suites of products. But if I was looking at, some of the, not the big three, but down beyond, I'm sure people have got to be looking at Roundhill. It's been an absolute home run, coming up with differentiated products. There's folks that I could see that fitting into. The question is, do you buy that product? Do you buy that asset base, or do you try to build it yourself? Because it's a little more niche, right? That there's a lot of risk in purchasing something that is, such concentrated asset like with DRAM for Round Hill or whatever. If we have a turn in the economy, that price, it went up 100%. It can come back down pretty quickly as well, and so that makes it very tricky to look at that asset as steady. There's a lot more risk with markets outside of your control with that type of purchase.
It's funny you mentioned Round Hill. In my predictions earlier in the year, Round Hill was one of the issuers I had on my list. But if I'm them now with how much success they've had, it's like I'm not selling to anybody.
Yeah, they're on
right?
fire.
It's like they're sitting back and they're absolutely killing it right
Yeah,
now.
Dave Ma's
Obviously,
team over there are doing a great job.
it's unbelievable. So I don't know that you'd
And
want to sell.
it's interesting how they're doing it, right? Like they're willing to say, look, take memory, take DRAM. There's not 50 companies to create a diversified allocation into that. There was 7 when they launched it. Now they've kind of expanded it a little bit. And so they're willing to lean into those derivatives to get that pure exposure. And clearly that caught the attention of the folks that wanted pure exposure. And because it held, 50+% foreign, the average trader is not going to pay a $100 commission to buy Sky Hynix or Samsung. So it was very smart product to bring to market at an incredibly smart time.
No question. Okay, so we'll continue to watch the ETF industry M&A. Let's move on to another topic that I've actually spent quite a bit of time discussing this year, but I just know you're going to have some hot takes on this. I have zero doubt. And that's this continued blurring of the line between investing and gambling. As you know, we have this parade of ETFs that continue to come to market that look much more like gambling vehicles than investment products. And as I noted at the top, just last week, late on Friday, we got filings from volatility shares for NHL futures contract ETF. So these would allow you to bet on the fortunes of your favorite NHL team. I guess first, what was your reaction to that? We can talk about the bigger picture here in a moment with this blurring of the line, but what did you think when you saw these filings?
I think it's hilarious that it was 5 o'clock on a Friday night. It's almost like when the White House wants to tell you something without everybody seeing it. I mean, I got a call instantly from Todd Sohn and said, "Have you seen this?" I was getting ready to go have a beer, and of course, then I had to spend an hour and a half reading about NHL futures contracts and ETFs. My initial reaction is, I'm not surprised by anything anymore. It's a wild, wild west. If I think part of what's going on with the ETF market, to take Corgi or whatever it may be, the spaghetti cannon of products, if you will, I think you're seeing a huge push down in the cost of launching product. So people are willing to launch a lot more and take risk because you never know where the demand's going to be. But to build, I mean, I can write an agent, and I'm not a lawyer, and I could write 1,000 prospectuses for ETFs today, and they would look just like every other prospectus you've ever written. It used to be you spend a fortune on that. So that's part of it, I think, is just the cost to bring these to at least file them and get them to market has come down drastically. It must have. Otherwise, where are these people getting their capital? The other thing is, I mean, I think I posted it on Twitter to response to somebody, I can't remember who, but I said the negative roll yield on these products is going to make USO blush. There is just no rhyme or reason if you read through those prospectus to believe that these are buy and hold products, right? I'm a huge Chiefs fan. You are a huge Chiefs fan. I could get a kick out of throwing $5,000 in a NFL team and say, I'm just going to ride my Chiefs out. Hell, I wish they'd have done it 5 years ago. We'd be setting pretty right now. But it doesn't make any sense. And I think at some point there has to be a grown up in the room that steps up and says, let's take a step back and ask ourselves, what are capital markets, right? And capital markets, if you remember what you learned in school, if you're in this business, the idea of capital markets is to efficiently allocate unproductive capital and incentivize it to go to efficient, productive assets, goods and services, right? And our government should be trying to find ways to incentivize folks that have cash on the sidelines to put it into a productive asset. And that's generally what our capital market structures are, right? That's the investment. It allows everybody to participate. It's not cheap to build a data center, right? Capital markets allow money to come in and, reward people for investing, but also provide the capital needed to create that data center, which is going to be a very productive asset for our country. All this stuff is not productive. And I think our government needs to find a way to separate. I'm not saying we don't need, like, derivatives have a purpose. There's a lot of good reasons to have derivatives markets, but we need to find a way to incentivize the right type of investing and disincentivize the wrong. Not saying we shouldn't have it, but we don't need to go out of our way as a government or regulatory body to incentivize speculation. And I just think if we fundamentally think about it that way, I don't have a problem with it. Other than I don't think we should incentivize it. And we're allowing too many things, and I might have a little conversation about this with crypto too, to be incentivized that produce nothing for our country. And that's the whole concept of capitalism is, private assets, in search for investing into productive assets. And if we start incentivizing the wrong things, it's going to lead to bad results, not just for that investor who speculated and lost, but for the broader economy as a whole.
I keep saying when I see these filings now that it's just all DraftKings now, right? Like you mentioned betting on the Chiefs. Well, I can go do that on DraftKings. I don't need to do that through my Schwab account. But I do think that there is a different mindset, particularly among younger investors. And I don't know if you saw this last week, but Bloomberg's Eric Balchunas, he posted a chart and that showed 52%. Listen to this, 52% of Gen Z investors have pulled money from an investment account to fund sports betting. Like think about that, Mike. They pulled money from an investment account to sports gamble. And I think this data came from a Betterment survey. But do you think that's what ETF issuers are competing against now? I appreciate all the words you had about we need to have the right incentives and where that comes from and helping people understand what a long-term investment is versus gambling. But it's almost like ETF issuers are competing against sports betting apps now. And that's why we're seeing a lot of these gambling-like products launch.
I don't have a problem with the pulling money to do stupid things, right? I think we all were young. We all wanted to go on a vacation and we're like, I want to do this with my buddies and I'm 23-year-old, I'm going to do it. Or I want to, go to the Super Bowl, whatever it is. And the only place you could get that capital was from your investment account or whatever. It's a bad idea. Don't do it. It's going to really hurt you in the long run. We all know the power of compounding, et cetera. But what they're doing is they're allowing people to do it without penalty, right? So now you're opening up a whole new world. Like once you put this in a regulated bucket, you leave a job, you have a 401k, that 401k rolls into a self-directed IRA. Now you can invest in anything you want without getting the penalty of taking it from your qualified account because it's deemed regulated. It's an SEC, registered investment product. And that's what we need to stop is, make it so that you can't get incentives to invest in a gambling vehicle.
But isn't the penalty, I'm just playing devil's advocate, isn't the penalty ultimately losing money? Because you and I know what the odds are on having a successful longer term outcome. And I think we would both agree, let's just take Gen Z investors, and maybe they're more predisposed to gambling. That's a whole different conversation we can get into. I think that ties into the rise of social media. There's all sorts of things that go into that. But just at a high level, I think if they get into these gambling-like products, the odds are not in their favor. Ultimately, they're going to lose money. And then guess where they're going to turn? They're going to go, at some point, I'm going to go invest in VOO and IVV and everywhere else. And that's where I'm going to put my long-term money. So I think that's where I go back and forth. I think you and I are in agreement in that I don't have a problem with these products existing as long as they do what they're supposed to do. But them being out there in the wild and there's so much attention around here, it does create this culture where you and I were both young pups at one point in time, and it's enticing. I'm going to go, bet on this. I'm going to go put money in a triple levered that. It's just enticing. It's a different mindset. But I do think ultimately investors have that experience. It'll probably be a negative experience, and then they'll move to more core portfolio products.
I couldn't agree more. I think everybody learns a little bit. Everybody has a different, if you did the survey and asked what percentage of the people that did that were, guys versus gals, I think it would be a staggering percentage tilt as well. It's just kind of the nature of the beast. All I'm saying is we don't need to have a regulatory body that encourages it. And you put this, there is this concept, and this is, one of the things I had, the concept around crypto, if you want to kind of gateway in there, but you don't need, you put it into a registered investment vehicle, you are quasi giving it some sort of stamp of approval. It's like, oh, the SEC, said this was okay. And we know that there's a lot of products out there that shouldn't be used as long-term investments, whether they're commodities, futures products, or whatever it may be. But there's that quasi kind of stamp of approval piece that I don't like about this. And I think, if you want to gamble, go to DraftKings. If you want to use leverage, figure out how to use leverage on your own in your trading account. And we can't make it so easy to do. And I think that's a pathway to disaster.
But are you saying regulators shouldn't allow things like spot crypto ETFs or these NHL futures contract ETFs or triple levered ETFs?
I think yes. I think there's a point where regulators need to say no. I completely, that is my statement. Bitcoin, Ethereum, I'm not going to have that the philosophical argument whether it's a good investment, bad investment. I get why putting it inside of an ETF wrapper like gold, like we did with GLD back in the day. But now you've got every coin that comes to market. Like Hyperliquid is not legal in this country, yet it is in an ETF wrapper. You can't use Hyperliquid here in this country, yet you can buy the token inside of a SEC approved vehicle. I don't think that's okay.
Yeah, I just, with this blurring of line between investing and gambling, if you want to lump crypto into that, I think there's certainly some elements there that fit the bill. It just feels like, and I actually posted this on X, it feels like we're barreling down this path to where somebody like Charles Schwab's going to acquire DraftKings, and it's all like the same, which is what I was saying earlier. I actually said that's a prediction of mine, right? That a major brokerage is going to acquire a major sportsbook in a few years. I don't know that you and I are going to stop it. I go back and forth on this just because, again, if somebody does want to go gamble their life savings away on DraftKings, they can do it. Or if they want to walk down to the casino or wherever, they can do that, right? This is America. But I'm also with you on the sense that, as you know, I have a strong passion around financial literacy and making sure people do the right things longer term, and having these products out in the marketplace and with the amount of hype and marketing and everything around that doesn't foster that financial literacy that we know is needed to be a successful long-term investor. And even if you look at these NHL futures contracts, I was poking around on CME's website because that's who has the underlying contracts, and they describe them as a hedging tool. Like this is a way for sponsors of the NHL and arena operators, et cetera, to like manage their financial risk that's tied to the team's performance. And so they're out there as like, this is some sophisticated, hedging tool, but that's not how people are going to use these.
Like a $1 billion sports owner can't go to Goldman Sachs and say, write me a, structured product to hedge my outcome of my team. Like it's a joke, right? I mean, but they had to do that because that's how they see them getting approved, right? Like there needed to be that legitimacy, though. There's no problem writing double 2x every ticker in the U.S. stock exchange, which Dave Nadig pointed out is probably going to happen at some point. We're going to have the whole S&P 500 2x single stock. It's crazy.
Do you think ETF issuers should have a greater responsibility here? You mentioned regulators stepping in. Should ETF issuers have a greater responsibility, or do you get it? It's like, again, this is capitalism. They can get the products to market. They know there will be at least some audience, or they can put a bunch of products out there, and if one hits, it's a home run. How do you think about that?
It's a really hard one for me. I personally think so. I think that if you're pushing a product that is going to decay to zero, you shouldn't be doing that, right? If the math says holding this, and the investor is going to hold it because they're a huge Boston Bruins fan, and they're going to hold it to zero as the negative roll yield continues to roll out, I do think there should be some responsibility there. But the bigger picture is, I think I have no issues with folks that have launched 2x stock ETFs, something like that. I think we live in a capitalist market where if there's demand, give them the supply. But I think the regulators do have a responsibility. And that goes back to my whole point of the capital markets. if you can prove that this is productive for our, society, regulators should find a way to incentivize it. If you can't, you're purely bringing a speculative vehicle to market, then you should not be afforded the same incentives that other types of products get. And I'm sounding like a curmudgeon. I know I am, but I can't help it.
We'll move on here, but we've brought up crypto ETFs several times. I tend to focus on those quite a bit. Anything have your attention in this space at the moment, other than what you already mentioned, or do you still view this all as like vaporware?
Who's going to be right or wrong about the long-term success of investing in crypto? And I've always been a long proponent. I believe there's a technology aspect that can help a lot of things to the idea of the digital ledger and all that good stuff. I think the biggest takeaway I have is the ETF is an undefeated wrapper, right? Like it's just, that's the reason I think regulators need to understand, like if you don't stop this, we're going to have baseball cards that are trading in, ETFs and everything else, because the structure is extremely powerful. And I think that's my biggest takeaway recently, especially with the more recent cold wallet hack. I don't even know the name of it, but whether, be that or this, but big picture, crypto falls into that bucket for me where a lot of things do, where, does it need to be falling under the 1933, 34, 40 Act, which were designed to protect investors that were putting things into productive assets? Do we need to be putting our stamp of approval on all these products that have no productivity? Because you are afforded, and you get certain incentives for being inside of these wrappers, like that is provided to you by our government, by our regulators. And I think the regulators should say, does this fit what the intention was all along, and not just kind of falling into this mentality of, will somebody buy it?
I absolutely love your point that the ETF wrapper has become so powerful. And we think about all the back end plumbing in terms of authorized participants and market makers and how all of this works, that it's become so easy to put pretty much anything within that ETF wrapper. But just because we can, maybe doesn't mean we should. And I think that's what you're getting to. I know we're running a little short on time here. I've been monopolizing our time with some of my topics. Before I let you go, are there maybe 2 or 3 ETF stories that you're watching the rest of the year or even into 2027?
Yeah, I mean, I believe that leverage is run amok. And I do think we're going to start seeing some derivative hiccups. That's what I'm keeping my eye on. And I think kind of just let's bucket all that derivative stuff in there. There's a lot of good stuff. We just talked about NEOS and synthetic income and buffers, and they all have use cases, and there's some really good use cases and how they work. And then there's just a lot that's just there to YOLO, like it's a speculative trade. And I think with the demand of some of these products in this current market, we're going to start seeing some hiccups in terms of, I can't get the total return swap I need for this ultra focused ETF that has, huge demand in it. So I'm going to start using options because I can't guarantee the return of a single stock. Or I'm going to go down and use a counterparty that maybe isn't Goldman Sachs or maybe isn't, Morgan Stanley or a reputable bank who has it. And then, people are going to learn what counterparty risk means all of a sudden. And I think I'm keeping an eye on that. And I also think we'll start seeing some huge tracking errors that'll pull out. I mentioned to you, I'm very disappointed with the actively managed wrapper. We're actually doing an exercise at ETF Action right now to add a new classification between true active and active because it's easier, right? With the SEC rule, it's easier to launch an active product and you don't have to pay an index provider. You're not going to have a due diligence committee. So, hey, you've got a 22% tracking error to your index, right? And I think some of these products are purely passive, right? I mean, Corgi is not actively managing. A lot of their products, I like what they're doing. It's nothing against them. They don't have a big enough staff to actively manage 185 ETFs, right? These are purely rules written, but it was way easier to launch them as active. And you're seeing that in these products that are derivatives too. So I don't know what is DRAM's tracking error to if you had just held those stocks. right? It's a lot of derivatives. The cost of owning some of those, the cost to carry for those have to be huge, but there's no transparency to that cost because of how it works. So that's something I'm just watching in general. That's a big area. And the other thing, and this is a big shout out to you, Nate. You guys, started the CETF certification, this certified ETF person. I think we need to go back to the basics in a lot of ways, and I think most, really good advisors, RIAs haven't ever left them. But as more and more ETFs come to market, you still have to challenge things. And I'm not going to throw out tickers. I have a lot of clients in this space, but you get into a trend where, especially like in the fixed income space, take a core enhanced vehicle that's getting, $1 billion of flow a month or $2 billion of flow a month, and it's an actively managed, core fixed income product with a little bit of high yield. The market makers know damn well that's a one-side trade. Everybody's buying. And if I go look at the spreads on some of these, the spreads are like 1-2 cents. Like, oh, it's ultra liquid. It's got all this volume. The spread's 1 or 2 pennies. But then you look at the premium and discount, and there are some of these products that are trading at 25, 30 basis point steady premium. You're paying 25 basis points extra to get into that vehicle. It's actively managed. So you're already paying a lot more than the beta product. And we're talking about an area of the market where your ultimate success comes down to basis points. You're fighting for basis points in this market, right? And I don't think anybody's talking about it. So I do think, going back to the basics and knowing, hey, I'm going to buy into this product. It's a great product. I love the manager, but know that your total cost is not just that expense ratio. And I could go on and on about different types of stuff like that, but that's a big theme for me and something I'm watching. I'm trying to do a better job as a data provider at a data intelligence platform of highlighting, where these anomalies exist, because on the surface everything looks fine, but if you start looking underneath, sometimes you're getting taken advantage of because it's gotten so large and it's not as transparent as maybe it was supposed to be.
I think a ton of excellent points there. We could do a whole nother hour. Let me ask you this on that second point. You're just saying that you think investors and advisors, they need to be paying more attention to things like premiums and discounts. And it gets back to, back to the basics, understanding total cost of ownership. It's not just looking at the price tag on an ETF. There's other factors there, whether it's bid ask, premiums and discounts. That's your point on that, correct?
That's exactly my point. Yep. It's just to look at those big ticket items and say, it's still your job to do the due diligence and know, is this make sense why I'm paying this?
And then just going back to your first point, what's interesting about that is it's sort of a counterpoint to what we were talking about, in that we've said the ETF wrappers become so powerful that anything can be wrapped in it. But it sounds like what you're saying when you talk about things like counterparty risk or issuers, maybe having to use options instead of swaps or whatever the case may be, that as powerful as the ETF wrapper is, perhaps in certain categories it has limits. Is that what you're saying on that one?
Oh, absolutely. Yes. I mean, unless the market cools first, we will have a situation where somebody launches a 2x, whatever on a product that's got on a stock that has a $5 billion market cap, and the ETF is going to run to $2 billion. The market will push back on that, right? The counterparties will say this can't work. The product will break. We'll also eventually have a product go belly up, or multiple in a real pullback where the market pulls back 30%, and some of these will pull down 80-90%, and they'll just flat out be a complete wash.
Well, Mike, fantastic conversation this week. Real quick, tell everybody about ETF Action.
Yeah, so ETF Action is a data intelligence platform. We curate our data sets from FactSet, make it clean and simple for financial advisors to navigate the ETF space. We work with a large percentage of the ETF issuers in the market to help them with competitive analytics to understand their products relative to the market. But really at its core, we're an institutional data set. We like to call it data intelligence because we curate it, make it easy to navigate, and we kind of fit every role. Everything from, we have a number of individual investors who use our platform every day. We have a lot of free stuff we give out there, but primarily we're for financial professionals, and we think about that between the issuer community and the financial advisor community.
And everybody can find that at etfaction.com. Mike, again, great having you back on here. I always enjoy visiting. Thank you for joining me.
Thank you, Nate.
That was Mike Akins, founding partner of ETF Action.
Navigating the ETF market? Get the precise data and analytics that smart investors rely on. Build a stronger portfolio today at etfdb.com.
I'm now joined by Paul Baiocchi, head of fund sales and strategy at SS&C ALPS Advisors, who currently offers 26 ETFs, nearly $23 billion in assets. And as I alluded to at the top, they've had a really nice year of inflows thus far, approaching $2 billion in new money. And there are a couple of ETFs in particular that we're going to highlight. Paul is now joining me from Denver. Paul, always a pleasure. Welcome back to the podcast.
Yeah, likewise. Good to see you. How you been?
I've been fantastic. And, I was perusing your ETF lineup, and there were a number of ETFs that stood out to me. I think several of which we've discussed before in talking about the AI infrastructure trade. But I thought it might be interesting to look outside of that area because we know that area is clearly getting plenty of attention right now. And so I thought it might be good to look elsewhere. And the two ETFs that we're going to talk about are actually two of the most popular ALPS ETFs overall. So there's one on the equity side and one on the fixed income side. And I think there are some broader ETF stories we can get into around both of these as well. And so the first ETF is the ALPS International Sector Dividend Dogs ETF, ticker IDOG, of course, great ticker. Let's do this. Do you first want to briefly explain the strategy underpinning IDOG, and then we can talk international stocks more broadly?
Yeah, so the dogs of the Dow philosophy, if you will, is pretty old. I mean, it goes back to really the 1920s, 1930s. And the idea was take the 5 highest yielding stocks in the Dow Jones Industrial Average and at the beginning of the year. And historically, there was a mean reversion to high yielding stocks. Now we're in a very different investing environment now. And certainly when you think about an old world investment strategy, it doesn't always port to the modern market. But what's interesting about the dogs of the Dow theory is that it orients toward value and it orients towards dividends. But you can't really build an investable, maybe in 2026 you can with swaps and the like, but you can't build a diversified RIC compliant ETF with 5 stocks. So what you do is you reconfigure the approach to a broader suite of stocks. The original version is SDOG, which pulls from the S&P 500. IDOG, which we're talking about, takes equivalent of EFA. And what you do is you go into the 10 sectors of the market, you pull the 5 highest yielding stocks at the beginning of the year, and you equally weight those stocks. And so it's kind of a mix, if you will, of equal weighted, but also dividend focused. And there's a sector balance that's inherent in it because you're equally weighting 5 stocks from each sector. So what you end up having is a very value-oriented approach to the market with typically a higher yield than the market. But that sector balance is really stark when you think about SDOG relative to the S&P 500, or in the case of IDOG relative to EFA, which when you look under the hood of EFA, Nate, as you know, you get a ton of financials exposure in developed ex-US markets. And there is this long tail of smaller banks that you may or may not want to own. Whereas in IDOG, you only have 5 financial companies, and then you have 5 companies from materials and industrials and other sectors of the marketplace. So you have a much more balanced sector profile. And I would say, if you look at year-to-date performance, and even going back further, we were talking ahead of this about really the past 2-year outperformance of developed ex-US compared to the domestic market. That value orientation, that yield orientation has been a big driver of the relative outperformance of a lot of popular strategies in the category.
But if we were to just summarize IDOG compared to some of the popular plain vanilla developed international ETFs out there, does it come down to that value orientation you're mentioning, maybe some dividend yield pickup? I just want to, if I'm an advisor or an investor looking at this category, as you know, I may say, okay, I'm going to look at some of these popular plain vanilla developed international ETFs. I'm looking at IDOG. Like, is that the main difference?
It absolutely is. I would say if you just look at a style box comparison of IDOG to EFA, which is the baseline for most people's developed ex-US allocation, you definitely have a significant overweight to large value within that universe. You're sort of underweight a lot of the growth in that universe, but the yield pickup is meaningful relative to the broader market. Now, there is a point to be made here, Nate, about the sort of capital markets culture, if you will, in different parts of the world. In the United States, I would say dividend payment and dividend yield has become a smaller piece of the investment lexicon. And certainly when you're thinking about running a company or a CFO, you're in the C-suite, dividend yield isn't as big of an attraction for investors outside of certain sectors of the market, whereas there is and has been historically a much more durable yield premium in developed ex-US markets on the dividend side. And that is very much true when you look at IDOG versus EFA. EFA starts with a fairly high relative dividend yield to the US market, but then IDOG just enhances it through its methodology.
Going back to your comment just on international outperformance overall, as you know, it's been stark. So I pulled the data. If I go back to the beginning of last year, IDOG is up about 65% versus 34% on the S&P 500. The question I'll ask you, Paul, is that sustainable? And obviously you don't have a crystal ball, but I think that's a big question everybody has is, can this continue? Or will U.S. stocks charge back ahead like they have for the better part of the past 15 years? How are you thinking about that?
Yeah, thanks for hedging the question by saying I don't know what's going to happen, but I do think history is often an important reference for investors and allocators. And when you go back for the past 16 years prior to last year, the U.S. had outperformed developed ex-US every year over that period of time, which was basically a record. And typically you get these periods of US outperformance, 8 years, 9 years, and then it reverts to developed ex-US or the international markets outperformance. And so if these cycles tend to repeat themselves, then on a go-forward basis, there is a strong possibility that developed ex-US and international markets will outperform. But I think a lot of it has to do, Nate, with the direction of the dollar. We've seen fits and starts of dollar weakening over the past couple of years. We've seen periods even within 2026 where the dollar was weak and then the dollar was outperforming, or the dollar was up against the basket that it's measured against. And that is typically one of the most important factors for developed outperformance is a weakening US dollar, because logically the increasing value of foreign currency relative to the dollar means the repatriated value of those positions goes up in a declining dollar environment. So if we are set to embark upon a period where the dollar is structurally weak over a significant period of time, then I do think developed ex-US has a really nice setup. And if you just look at valuation spreads, they've compressed a little bit, but on a relative basis, the PE, both forward and trailing on developed ex-US markets, is significantly cheaper than that of the United States. You can make arguments as to why, and sort of the durability of strong earnings growth here in the United States, which, by the way, the earnings growth that is being forecast at the moment for the US market is really unlike anything we've seen, at least based on trajectory. So I would say the challenge if you're an advisor is that for 16 years you had developed ex-US in a portfolio as a diversifier, and it just didn't perform. And so you had these difficult client conversations every single year. And then finally, those developed ex-US markets start to wake up, and you point to it and say, here you go, look, it's up 30% over the US market over a 1.5 year period. And in some ways, then naturally the question is, well, can this be sustained? Can this continue? And I think there's a lot of advisors who sort of threw their hands up on developed ex-US going into 2025, and maybe they're starting to leg back in because maybe their clients are starting to ask about it again.
To that point in conversations you're having, are you finding that advisors are significantly underweight international equities? Because that's been the narrative, right? That we've had this bull run in the U.S. I think a lot of investors did throw up their hands and said, you know what, I'm staying away from international, or at least minimizing it. So are you still seeing that when you look through the portfolios?
I would say yes. There is very much a structural underweight. I would say, depending on the target allocation that you have, we found that neutral, quote unquote, for developed ex-US or an international allocation is somewhere in the neighborhood of 10, maybe 15%, maybe in certain frameworks, it's upwards of 20%. And we just don't find it very common that advisors are overweight developed ex-US, and oftentimes they're not even at that neutral allocation still, despite that relative outperformance we've seen over the past 18 plus months.
And so what's the message to those investors, at least the ones who are underweight? Is it just a message of diversification, or is there anything else that goes along with that message?
Yeah, I think you're drafting on the idea of market concentration in the United States, concerns about the profitability profile of hyperscalers, which, by the way, dominate the weighting in the S&P 500, the benchmark most people use, and everyone sort of looking for ways to diversify away from that concentration risk. And being a sort of student of behavioral finance, one of the things that is very common is a home country bias in an allocation decision. And so how do you, in some ways, weave this idea of developed ex-US, even emerging markets to a degree, into the conversation around concerns about concentration risk in the market and a lack of diversification in your typical asset allocation framework. That said, then you sort of build on that with the idea that you've got these sort of cycles historically whereby developed ex-US has proven to be a durable outperformer over long periods of time in the past, but it's been so long that we've seen a durable period of outperformance from developed ex-US that you first have to make the case for the portfolio contribution of a developed ex-US allocation, and then on a relative basis, what IDOG can do compared to the benchmark or compared to other methodologies in the space.
Yeah, but obviously, if that outperformance continues, both from international more broadly and certainly IDOG more specifically, there's no question investors are going to continue to look that direction. Let's move from international equities to actually U.S. bonds, so polar opposites, because the other ETF I want to ask you about is one of your most popular by assets, and that's the ALPS Smith Core Plus Bond ETF, ticker SMTH. And I was looking this morning, this has taken in over 700 million just this year. What do you think's been driving that interest? And maybe talk a little bit about that strategy itself.
Well, I mean, with ETFs in general, getting a model allocation from a large asset allocator is a massive tailwind in terms of flows, because anytime new money comes into that firm and they're allocating via the model, there's a structural buyer that exists. And so we've been fortunate to have a really large asset allocator early on who bought into the story, believes in the firm that we have a great relationship with, and has been a structural buyer of it. But I would say the simplicity of the message from Smith is what we find so compelling to advisors. They're not an active manager who promises to provide this type of alpha-seeking orientation within their decision-making process. They're very much old school bond managers. Gibson Smith, who runs the firm, was a CIO at Janus forever. He helped build them from what was known as sort of a growth equity shop to one of the larger fixed income complexes in the country. And over the course of his career, he's been through a number of different market cycles, and he's created, along with his team, and the team that he built is quite expansive and quite experienced, a process that is very consistent. And so the idea that you're not going to get too high when the market's in your favor, you're not going to get too low when you're in a challenging market, which, by the way, we've been in quite a challenging bond market here for 4 years or so. That consistency of your message, of your beliefs, and how it manifests in terms of your positioning and your portfolio management really resonates with advisors who want fixed income to do what fixed income is supposed to do. And SMTH is very much designed in a way that isn't something focused on alpha, isn't chasing duration, isn't chasing credit risk. It's very much designed to be a ballast in your portfolio, as fixed income should be in our minds. And I think that consistent, durable, repeatable process that's easy to articulate, and in many ways aligns with what a lot of advisors think about when they think about a Core Plus offering, is what's helped that strategy. And of course, Nate, I'd be remiss if I didn't mention just how the growth of adoption in active ETFs has accelerated here over the course of the past 4 or 5 years. And in many ways, we're able to draft on that massive trend.
On that latter point, I know we've covered this in the past, but with the rise of active, how does ALPS like to frame the active versus passive decision? Because you offer both, right? I look at your lineup, it's fairly evenly split between active and passive. And so just high level, how do you communicate that active passive decision to investors and advisors?
Yeah, so look, I think there's a lot of categories where the data tells you it's really difficult to provide meaningful risk adjusted outperformance in a given market category or in an asset class. Think large cap US equities is maybe the best example of that. And so often what we're talking about is the Bible of passive investing, which is SPIVA, and in categories where SPIVA's on your side, meaning history tells us that active managers can add alpha, can add risk adjusted outperformance. Those are typically the categories where you want to think about an active manager. Core Plus fixed income is very much one of those categories where you've got this index, the AG, which consists of thousands upon thousands of bonds and doesn't necessarily even represent the whole universe of fixed income eligible for a Core Plus strategy. And that framework in our mind creates an opportunity for value add from a manager with the type of experience and expertise that Smith has. And then you've got other categories like REITs, where we've got an active REIT strategy, and we believe wholeheartedly that the data is on your side in terms of an active manager's ability to outperform. So in our mind, it's about the various pieces of an asset allocation where the data says that an active manager should be able to generate meaningful relative outperformance, risk adjusted, of course, and then thinking about telling the story of that active manager. We're very fortunate, I would say, to have some really compelling active managers as sub-advisors. I mentioned Smith, GSI, who runs our REIT strategy, has been in that space for 3+ decades. You've got Brown Brothers Harriman running our active muni strategy. You've got Core Commodity, experts in the commodity space, running an active global natural resources equity strategy and CCNR. And so in many ways, it's taking the categories where we think active can work and be additive to a passive approach and can complement that in many cases, but also then going down the road of telling the story of our active manager, what they do, how they do it, and why it's important. And that is a fun conversation to have because we get to highlight some really smart people who really live and breathe the category that they're managing.
Before I let you go, just coming back to the fixed income space, any strong views on allocating to the category right now? And I'll just add, I feel like investors and advisors in general have been fairly reluctant to take on much duration risk. I do think they've been a little more comfortable with credit risk, though. If you look, credit spreads are still extremely tight right now. Just real quick, any strong views on allocating to fixed income?
Yeah, I mean, that point you made about credit spreads being historically tight would, in my mind, be a great advertisement for an active manager who's a little bit more conservative in their credit allocations and isn't necessarily reaching for some of these credits below investment grade or even in the investment grade category that are trading at such tight spreads. That's one of the benefits of having a manager like Smith on SMTH is they're never going to get too far over their skis in their credit allocations in market environments that they feel are maybe a little bit overvalued. And then the other piece, I think, is you're right. People have been hesitant to take on duration risk because we've seen a number of head fakes in the 10-year and in the longer duration segments of the bond market. And now you've seen rates back up, especially in the 30-year, in a way that we really haven't seen in decades. And in many ways, that's a concerning data point for advisors. But again, just leaning on history, we know that the starting point of yield from a total return perspective on a fixed income portfolio is critical. And at a starting point of yields at these levels, history is very much on your side. That doesn't mean that total return is going to be strong. It doesn't guarantee you anything. But in many ways, I think people have been so hesitant to take on that duration risk because of the uncertainty around Fed policy, the trajectory of inflation, economic growth, et cetera. But at a high level, given where yields sit, this is often, at least historically, a time to consider getting into your intermediate bond exposure, your core plus bond exposure, and letting it compound over a long period of time.
Well, I think a good spot for us to end our conversation. Paul, excellent perspective. Always enjoy our chats. Thank you for joining me. That was Paul Baiocchi, Head of Fund Sales and Strategy at SS&C ALPS Advisors. That'll do it for this week's ETF Prime. Build your ETF expertise and separate yourself from your peers by registering for the ETF Institute Certified ETF Advisor Program. You can learn more at cetf.org. Next week, I'll be joined by Robert Hum, Head of Investment Product and Commercialization at SEI, who I feel like they've been an under-the-radar ETF success story. If you look, their ETF lineup is quickly approaching $10 billion in assets, including over $2.5 billion in inflows just this year. And so we will find out exactly what's been going on there and look at several of SEI's ETFs. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.